Gentlemen, we are discussing about the financial modeling and data analytics paper, December 2023 sitting. The focus is on question 23, and you are presented with the following information right on the left of your screen here. You'll be given the stock name, Z-Term Kenya Limited, Car Assemblers, Ujenzi Centum, Cement, Kilimo Bora, Nairobi All Share Index, and you've been given the ticker symbol right over here. You've also been provided with the portfolio compositions, and all of these total to 100%. And how you can be able to just quickly check is by scrolling down over here, and you can see that the sum is 100% right here. You are presented with the weekly returns for all of those companies, or all of those 4 companies, including the Nairobi All Share Index. Now, you are required to calculate the weekly returns for each of the individual stocks and the Nairobi All Share Index, calculate the wage portfolio, the average portfolio return for the historical period. You're told to calculate the standard deviation for each of the individual stocks and the Nairobi All Share Index. Then you're told to calculate the standard deviation for the portfolio returns to assess its risk, and to calculate the beta each individual stock of the portfolio, which measures its sensitivity to the market movements. And you can see these are 20 marks. This is 20 marks question. So the way I've decided to arrange the information is to arrange it as you can see on the right of your screen over here, to calculate the weekly returns for each of the individual stocks of the Nairobi All Share Index. So we just pick average, not average A. You can see the average right over here, and the average of what? We want to pick the average for Z-Term Kenya, to pick the average values right here. Up to there, close the brackets, then you enter. So we're saying that the average return should be negative 0.2%. Let's put it to maybe say 2 decimal places. Like that. 2 decimal places is up to there. And if we were to drag it moving towards the right, we wouldn't be wrong, because we're saying that it picks the average for car assemblers. You can see car assemblers, it picks it right there. So that's what they're saying, the average, the weekly returns is given to us right there. Escape. We move ahead and answer part B of the question. You are told to calculate the average portfolio return over the historical period. We have been given the portfolio composition, and the portfolio composition can be linked with this top part right here. The portfolio composition is there. Enter. And we link it with all of them towards the right, control R, like that, so that you can be able to pick the portfolio composition. Remember, we have computed the average weekly returns above here. So we just link it with up above there, and then we drag it, control R, like that, the same values, excluding the All Share Index. Because this, all of these portfolio composition total to 100%, as you can see down here, we cannot be able to include the All Share Index into our portfolio. How do we get the average portfolio return? Pick plus, we open the brackets, that value times the average weekly return plus that value times that value, close the bracket, the portfolio composition multiplied by the average weekly return, close the bracket, and then we add finally the portfolio composition for Kilimo Bora, and we multiply that with the average weekly returns, like that. Oops, that, close the bracket, and we enter. So I think I didn't put I didn't put open a bracket here, that's why it's giving me those values there. So we open a bracket over here, and then once we close it like that and we decide to enter, it will actually be okay. So we only want it into the 2 decimal places, so we just sort of reduce it like so to 2 decimal places, like that, 0.35%. Now once we've gotten our portfolio return as 0.35%, we can move on to part C. Calculate the standard deviation for each of the individual stocks and the Nairobi All Share Index. That's 4 marks. So average standard deviation would be, you pick STD, stud dev, not P, because we're not picking for the entire population. We want stud dev, standard deviation for the sample. So you double click that, and we can be able to just pick the value for these values here. We highlight this value for Z term. So we highlight it down like that, and it picks to calculate for us the standard deviation for Z term. And we move up over here like this, we can be able to see we already have that given to us there. And if we were to drag it moving towards the right like so, up till All Share Index, it will actually pick the standard deviation. Remember, for example, this one is picking the standard deviation of the sample for the index, for the Nairobi All Share Index right here. Part D, we asked to calculate the standard deviation of the portfolio returns to assess the risk. And we're saying for us to be able to do that, we will need to consider the weights. And the weights would mean that we've already had the standard deviation over here, compared to us over here, but now we need to factor in the weights. And we're saying it's going to be, we pick that standard deviation times its corresponding weight over here. The corresponding weights were given to us over here. We can use that, or we can even use this portfolio composition right over here. So we close the bracket and we open another one over here so that it can actually pick the values as the way we want them. Then we add the standard deviation over here. I forgot to open the brackets, so we open it right above over here. You can see it on the formula bar here. So we open the brackets there, and then we multiply that with car assemblers corresponding portfolio composition weight. We open the brackets, we pick Ujenzi Bora standard deviation, weekly standard deviation, times the Ujenzi cement over here. Then we close the brackets, plus we pick this value here and we multiply that against that value there. Open the brackets and we close the brackets like that, and we just click enter. So we can be able to put it in form of weights, and we can say it's about 06.02% standard deviation. So standard deviation of the portfolio is given to us there. So you pick the standard deviations of the individual securities and we multiply them by the corresponding weights. Then finally, we are asked to calculate the beta for each individual stock in the portfolio, which measures its sensitivity to market movements. The beta is given by covariance of the market and stock, so you can put it like so, covariance of the market and the stock. Then we divide that against the variance of the market, like that. And that's what we're saying we're going to do. Covariance of the market and stock, or covariance of the market. So we pick covar S, because we're looking at a sample, covariance, and we open it up right over here. Covariance of what? Covariance of the market. This is the market over here, so we highlight that part. covariance of the market, and on the second array here we put the stock itself over here, bearing in mind like that, covariance of the market and stock like that, and you can see what we've done, covariance of the market and stock. So we can lock the one for the market, so we are saying this one for G is one that you can be able to decide to lock, F4 and F4. Why are we locking it? Because we want to ensure that the covariance of the market remains like that. And then we do what? We divide now, divide by, you can see the variance like this. We divide against variance, or we just put it like that, variance of the market. But now, before we do the variance like that, we can say okay like that, because that's just the covariance like that, because you can see from the formula by just the covariance. Then we continue and say divided by the variance, not var p but var s, sample, variance of the market, based by this variance of the market. So we pick the variance of these values here and we lock it. So press F4 like that and we close the brackets like that. There, that's our beta, 0.0932. And if we are to drag it moving towards the right, let's just confirm. Covariance, remember we have locked, that's the purpose of locking. This one, covariance of the market. Look, this one has moved from initially Z term to now car assemblies. You can check the previous one over here, escape, check the previous one, you see it is now currently at Z term over Z term here. Now we move on to the second one, it actually picks, but it remains, this one remains, the variance of the market remains, the covariance of the market remains. So we can be able to say that the model is foolproof. Control R. But let's see if we're actually doing this the correct thing. We want to try and prove if we were to pull it towards the right, if you're going to get a beta of 1. You can see we already have beta of 1. Beta of the market is always 1, because it's covariance of the market, it's covariance of the market against the market divided by variance of the market. We always have that value being 1 there. And so with that, ladies and gentlemen, we have come to the end of question 23. Thank you for being with Manifested Publishers. We're always here for you. Be blessed.
Greetings and welcome to the lesson. The topic is the financing decision. Today we continue with the long-term sources of funds. So far we've covered equity, debt. Today we proceed to the third long-term source, known as hybrids, which is also known as hybrid instruments or hybrid securities. And these are financial instruments that combine features of both debt and equity. They possess characteristics of both the traditional debt and equity instruments, providing companies with a flexible and innovative means of raising capital. So in this lesson, we are going to discuss the characteristics of hybrids. We will look at the advantages of hybrids and the drawbacks of hybrids as long-term source of funding. Let us begin with the characteristics, the features, the attributes of hybrids. So candidates, by the end of the lesson, you should be able to explain or outline the characteristics of hybrids. You should be able to highlight the advantages and also the disadvantages of hybrids. So let us begin with the characteristics of hybrids. Now, the first characteristic of hybrids is the blend between debt and equity. Debt equity blend. Debt equity blend. Remember, I've just said that hybrids combine both the features of the traditional debt and the traditional equity instruments. And a good example of hybrids is the convertible bonds, the mezzanine debt. We may have hybrids like the warrants, the preferred stocks, and so on. So one characteristic is the debt equity blend. The debt equity blend. Blend means combining. Hybrids combine the elements of debt and equity, which then allows companies to benefit from both the characteristics of both debt and equity. That's first characteristic. 2, fixed and variable returns. Fixed or variable returns. Hybrid instruments may offer fixed returns that are similar to debt or variable returns that are linked to company's performance, which resembles equity. Fixed and variable returns. Then we have convertible features. Convertible. Hybrids, some hybrids have convertible features, allowing holders to convert their instruments into equity shares under predefined conditions. Convertible features. 4, participation in profits. Participation in profits. Hybrid holders may participate in the company's profits, receiving maybe distributions or even dividends based on the company's performance. Based on the company's performance. 5, subordinated nature. Subordinated nature. What does that mean? That means that hybrids are often subordinated to the traditional debt. They are subordinated to the traditional debt, meaning in the event of bankruptcy, the claims of hybrid holders come after the claims of the traditional debt holders. When it comes to prioritization, then hybrids are subordinate to the traditional debt. Then we need to mention perpetual existence. That's a key characteristic of hybrids. Hybrid holders may, the hybrid instruments have no fixed maturity period or date, which provides a perpetual form of capital similar to equity. Perpetual, it gives company perpetual existence. So these are 6 features. Then how about the pros of hybrids? What are the pros of hybrids? Pros of hybrids. The first advantage is flexibility. Flexibility. Hybrids provide flexibility in structuring financing, and companies can tailor the terms and conditions to meet specific needs, blending features that suit their financial strategy. They are flexible. It offers what we call tailored solutions. It offers, this form of funding offers flexible terms. It offers flexible terms and structure, which allows companies to customize by blending the two characteristics of debt and equity. You understand? It offers flexibility in structuring financing. And I've said companies can do what? Can tailor the terms to meet specific needs. Flexibility. Number two, it offers diverse investor base. Diverse investor base. Hybrids offer diverse investor base to the company, including both debt and equity investors, as well as those seeking a module or a middle ground between debt and equity. Diversity. Risk sharing. Number three. Risk sharing. How is it an advantage? Hybrid instruments allow for sharing of risk between the company and investors may benefit from the upside potential while accepting a level of risk similar to equity shareholders, equity holders. 4, it offers what we call enhanced capital structure. Enhanced capital structure. Enhanced capital structure. The capital structure is enhanced. The use of hybrids contributes to a more diversified and resilient capital structure, which optimizes the overall cost of capital. Then we have convertible options. Convertible options. How is this an advantage? Now, convertible hybrids provide the option for investors to convert their instruments into equity, which allows them to participate in potential capital appreciation. Convertible options. So these are 5 advantages. We will close the lesson by discussing the cons of hybrids. The cons of hybrids. The disadvantages of hybrids. The first obvious disadvantage is in relation to complexity. You understand? Complexity involves complex documentation, complex complex documentation, and that is a disadvantage, including negotiation, complex documentation and negotiation. Now, structuring and issuing hybrids may involve complex legal and financial considerations, which may require specialized expertise and higher transaction costs. That is a disadvantage. Complexity. It's complex in structuring these instruments. The hybrid structure can be complex, which can make it also challenging for investors to fully understand the terms and risks associated with the instruments. Complexity. Cost of interest rates, number 2. Cost of interest rates. Cost of interest rates. Cost of interest rates. Now, the cost of hybrids, including any fixed or variable costs, may be higher than the traditional debt. Additionally, hybrids are subject to interest rate risks, which affects their pricing and attractiveness. Costs and interest rates. That is a disadvantage. Subordination, from the word subordinate. Subordination. In the event of financial distress or in the event of bankruptcy, hybrid holders are subordinate to traditional debt holders, and that can impact recovery in case of liquidation. So that is a disadvantage from the point of view of the investors. For market acceptance. Market acceptance. The acceptance of hybrid instruments in the financial markets may vary. Do you understand? It may do what? It may vary. And investors' perceptions and willingness to invest in such instruments can influence the success of hybrid offerings. Because remember, we said that these instruments are complex. They are complex. They are not straightforward like equity or debt. There's also the feature of tailoring. Do you understand? So the market acceptance can vary. In the acceptance of the instruments can vary in the market, financial market, which can then affect investors, which affects investors' perceptions and also willingness to invest in such instruments. Market acceptance. 5, regulatory considerations. There are also regulatory considerations, what we may refer to as regulatory frameworks. And these regulatory frameworks for hybrids may also vary, and compliance with the relevant regulations can be crucial, or we can say is crucial. And companies must navigate the regulatory requirements when issuing hybrid instruments. Hybrids also are subject to covenants, which could be restrictive. Let me say covenants and restrictions. Covenants and restrictions. Now, similar to debt, hybrid agreements might impose covenants which can then restrict financial activities or future funding of a company, thereby limiting operational flexibility. Remember, we say that hybrids is a source of fund that combines both the debt and equity characteristics. It's a debt equity blend. So this feature of debt in relation to covenants and restrictions. And I've said similar to debt because some hybrids may take the form of debt, some features of debt, and one feature is having restrictive covenants, which might impose restrictions, financial restrictions, which may affect the operational flexibility of an organization. That is a disadvantage. So these are 6 drawbacks, 5 benefits, 6 characteristics. Characteristic number 1, hybrids. A hybrid instrument is a debt equity blend. We have fixed and variable returns for those who invest in such instruments. These are returns, it can also be costs on the part of the company. It has convertible features. We've seen that there are some convertible bonds that can be converted into equity based on agreed terms and conditions. For participation in profits, hybrid instruments or hybrid holders may enjoy participation in profits just like the equity holders. Number 5, subordinated nature. When it comes to prioritization, when the company is being liquidated, then hybrids are subordinate to debt holders. Hybrid holders will be subordinate to the debt holders. Then the source also gives the company perpetual existence. They do not have maturity period like debt. These are 6 characteristics. Then the first benefit is that of flexibility. Number 2, hybrids give the company diverse investor base. There is risk sharing. We also have enhanced capital structure and convertible options. Disadvantage number 1, complexity, cost of interest rates, subordination, market acceptance, regulatory considerations, covenants, and restrictions. Now, candidates, in summary, we can say that hybrids offer a unique financing solution by combining both the features of debt and equity. They provide companies with flexibility. They provide companies with the ability to tailor financing structures in order to meet specific financial needs. But on the other hand, the complexity of hybrids and market acceptance are factors that require careful consideration when incorporating them into the company's capital structure or in the company's long-term funding strategy. And that brings the lesson to an end. I'm going to give you an assignment, 3 questions. Number 1, what are hybrid financing instruments and how do they combine elements of both equity and debt? Number 2, in what situations might a company choose hybrid financing over traditional equity or debt? And what advantages or disadvantages does it offer? 3, how do regulatory frameworks and market conditions influence the attractiveness and feasibility of using hybrid instruments for financing? These are 3 questions. Attempt the questions before coming to the next lesson, where we are going to study the characteristics, the disadvantages, and the advantages of leasing finance. Lease finance. Bye.
Hello learner, welcome to Manifested e-learning platform. My name is FAM Lengwiri and I practice within the financial services industry in Kenya. Today we are discussing on the financial modeling and data analytics paper. The focus is on the December 2023 sitting. We are going to discuss on question 21. The question reads as follows. Eugene Shahira has been provided with a set of historical data by one of his clients, which include a set of assumptions, statement of comprehensive income, statement of financial position, statement of cash flows, and supporting schedules as presented below. And so you can see down here the assumptions. These are the assumptions that have been given to us here, and you can see they're presented in blue for the forecast period, and this is the historical results. We have the income statement, the balance sheet given to us down here, and the cash flow statement just under it. Finally, we have what is called the supporting schedules. We are required using the assumptions presented in the assumptions table, assist Eugene to complete the following statements of forecast period for the forecast period. A, the statement of comprehensive income, the statement of financial position, the statement of cash flows, and the supporting schedules. All of these total to 30 marks. So we go back up and start filling out the income statement based on this forecast period right over here. So the forecast period is from 2017. And we are going to start with the income statement. So the revenue, to model revenue, we have been given the revenue growth rate over here. And so we are saying that we are going to assume that the revenue is going to grow at 5% initially, 4.5%, 4%, 3.5%, and 3% in 2021. So we will increase this 150,772 by a factor initially of 5%, 4.5%, and so on and so forth like that. So let's do that together. So the first thing is to link it with that, and then we multiply by that factor 1 plus now this growth rate right over here, and we close the bracket so that now the model can be complete, or the formula can be complete. You can see in 2017 we expect it to be like that. So we drag it, Control R, and it picks the formula like that. Else we can do the following. If we don't prefer to do it like that, we just focus it like that, and we wait for that plus sign over here like so, and then we drag it like that. So we drag the formulas and you'll still see the answers are the same. How do we model cost of goods sold? Now we are told that the cost of goods sold is provided as a percentage of revenue. Meaning what? We get the cost of goods sold over revenue gives us 37.5%. I can do it right above, right beside it here. So you can say COGS over revenue will give us the COGS percent, which is this one right here. But how then can we use the COGS percent to be able to model the cost of goods sold? We just get the revenue and multiply it with the cost of goods sold percent, so that now we can be able to model the cost of goods sold, because that is what we're going to remain with over here, because cost of goods sold over revenue is cost of goods sold percent. So we cross multiply the revenue multiplied by the cost of goods sold percent, then we should be able to have the COGS, and that's what exactly we are supposed to do. We take that and we multiply, or the revenue, we multiply that with what is called the cost of goods sold percent as a percentage of revenue. Enter there, and like the same way we've done before, we just drag it, Control R. The gross profit, because it's a formula, we just drag it, Control R. Now we move on to the expenses down here. So the salaries and benefits, what are we told as far as the assumptions are concerned? We are told that the salaries and benefits are given to us in terms of shillings, 25,000 all through like that. And here we're saying it's going to remain as 10,000 in terms of the depreciation component. So because they're following each other like that, and these are considered to be fixed costs, we just pick them from above. There, just pick it up from there. And also because they're following each other, just drag it like that, put it like that. And then now, fill it out like that. What I've just done, I've just picked this one from here. And you can see from here, this is I32. Like that. So it's I32, which is this cell over here. But now, where do we pick it from? We pick it from I13. This is I13. I13 is this one here. So we're picking it just from there. And then also this one is going to be I14, which is down there. Now we move ahead and try and model the depreciation and amortization. In real life, trying to model depreciation and amortization will prove to be a bit of a challenge. Determining would be a bit of a challenge because we need to know whether it's going to be reducing balance or whether we're going to use straight line method. For simplicity's sake, the way I've seen it right over here, depreciation as a percentage of PPE, it's just based on straight line method like that, for simplicity's sake. So the depreciation and amortization is driven by percentage of opening balance of PPE. So we will initially leave it over here because we do not have the values of PPE given to us directly, and we'll model it a little later on. As well, the interest right here. The interest right over here is based on opening balance. We do not have the opening debt balance given to us here. So what do? We first of all leave those two alone like that, and we will be able to try and model them a little later on. So we put maybe say a faint color there on them, like so, to show that we're going to come back to it a little later on. Because these are totals, the ones in black are always totals, the ones in blue are hard coded values. We just drag them. That. Remember that this value here is bound to change, as well as this value is bound to change because of we've not filled out the depreciation, neither have we filled out the interest. Now the taxes over here, we have been told something about the tax rate right above here. You can see the tax rate is as a percentage of earnings before tax, and you can see it's 28% all through. So what does that mean? That this tax rate will be based on that value times the taxation rate which is given to us right here. So we link it with that one there. And because this is also going to change based on these values given to us there, we just drag it, and because Excel is very wonderful, it's a very wonderful tool, it will just pick everything, or it will pick the formulas based on the values that are inserted right at this point here. This is a formula, so we just drag it like that, moving towards the right. So we have partially filled in the income statement with the exception of depreciation and interest expense. We move over to the balance sheet and try and model it and see if you can be able to model some items. Cash will be the very final part that you're going to fill out, and it will be like what is called the balancing figure as we approach the end of the model itself. How do we model accounts receivable? The accounts receivable, if we can go back to the assumptions section over here, this is the assumption section right above here, you can see we've been given accounts receivable days. We've been given 18. And accounts receivable days is driven by revenue. So it is accounts receivable over revenue times 365. We can get this from these black formulas over here. So if you double click, you can see it is the revenue, or it is rather the accounts receivable, yes, if you said before, accounts receivable. We divide that with the revenue, and then we multiply by 365 to enable us get the days. Now that we've assumed that the days are going to be 18 over here for the forecast period, and you can see this is the forecast period here, 2017, how do we model the accounts receivable here? We are going to move ahead and say that it is accounts receivable, like that, is given as how we're going to model it over here. We'll pick the revenue, because we've said that we already have the accounts receivable days, and then we divide that, or rather, let me just tell you what you're going to do, because the formula is given to us right over here. You can see this is it over here. We are saying we're going to get the revenue, or rather the accounts receivable, over the revenue times 365. So we're just going to do this. We are going to pick the days over here, accounts receivable days. So accounts receivable is going to be given as the days, and then we multiply that with the revenue, and we divide this, all of this, by 365, by 365 over here, 365, that. So days times revenue over 365. We've just adjusted the days. Initially, for us to get the days, we're saying we get the accounts receivable times 365 over revenue, just rearranging this formula. And that's exactly what we're going to do over here. We get the days are here, see where they are, just a second, accounts receivable days, there, and then we multiply that with the revenue, then we divide over 365, and we have that value given to us there. So shift Control R, we model that. Inventory is driven by cost of goods sold. So in a similar fashion over here, the formula here, we'll get inventory is given as, or given by, the inventory days times COGS, not times revenue, and here we're dividing against 365, that. So that's what we expect over 365. So that's what we are going to do. We pick the cost of goods sold there, just to double check, cost of goods sold times the days. Which days? The inventory days right here, 73, divide by 365. Once we divide that by 365, then we should be able to get the 11,715. We drag it. PPE, or property, plant and equipment. Remember, this is the one that is going to drive our depreciation component over here. But since we don't have it yet over here, we leave it out for now. The second time coming down, we will be able to fill it out, because this is a formula. So shift Control R. We can proceed on to the liabilities. Obviously, these values are bound to change because we've not filled out the cash, neither have we filled out the PPE. So the accounts payable is driven by cost of goods sold. The same formula over here, only that we're going to put now accounts payable. Now over here, payable. Payable for revenue 365. we look for the accounts payable days, you can see the accounts payable days are here, 37, and then we multiply that with the cost of goods sold and then divide by 365. That's what we get. The debt, we will be able to fill out the debt and link it with the debt component from the supporting schedules. So here we drag it like that because this is a formula here, it's just the total. So this one I'll put it in a different color so that for consistency's sake to maintain to show that this is the part you're going to come to later on and fill it out. In terms of the equity capital, we are going to link it. So we're going to drive it previous equity capital, then we add any new issuance and repayment of equity. So we come back up over here to the assumption section, this assumption section. Was there any issuance and repayment of equity from 2017? There is what we link it with over here. And we enter. The retained earnings is driven by the previous retained earnings plus the net earnings for the current year, which is this one here. Remember, this value is going to change because of these two, depreciation and interest. Enter. We drag them towards the right. And this one remains like so. So shift, control R. So it picks the formulas as the way they are. Remember, in a balance sheet, we always have a check. This check, with your permission, it will obviously not balance because we are saying that here we have got some missing items. You can see it's not balancing at all. But it's up to our responsibility, based on what the examiner has asked us, to fill and ensure that this one balances off, the balance sheet balances off based on the forecast. Now, as far as the cash flow statement is concerned, we will first of all ignore it for now. We ignore the cash flow statement and we will be able to also do a check for the cash flow statement and write down over here to determine if we are actually cooking figures or not. We jump onto the supporting schedules. These supporting schedules are broken down into three: the working capital schedule, the depreciation schedule, and the debt and interest schedule. These schedules, these three of them, are instrumental towards filling in the missing items in the balance sheet, income statement, and the cash flow statement. So from here, the accounts receivable. You remember we had modeled it just above there in the balance sheet. So we just fill it out, link it with the one accounts receivable here. And you can see the accounts receivable is here, so we link it right over there and we put enter. Because they are following each other with the inventory, I can just drag this sort of down like that and it picks from above. The accounts payable, we also had filled it out or computed it above from the balance sheet here. The accounts payable, as you can see right over here, is 5938. You see, it's okay. Link it like so. Then these are black. It means that they are formulae. To get the net working capital, we get the accounts receivable, we add the inventory, and then we less the accounts payable. That's how we get the net working capital component. So just put it like that and it picks. The change in net working capital is the difference between changes in this year from last year's. You can see the formula there. This value subtracting that value there. So I'll initially fill it like that. Then now I can drag it moving down like that. Shift, Control R. So once we have those values given to us there, we are saying that now the working capital schedule is complete. The change in net working capital is going to be useful in computing some items in the balance sheet or in the in the cash flow statement, pardon me. So we move down to the next supporting schedule, depreciation schedule. Now we can see something that is very unique from the historical values here. This value, which is the opening PPE, is picked from the closing value here. This value has been picked from the closing value here. This one has been picked from the. So it goes without saying that this value here will be picked from the value there. How much is our capex? Our capital expenditure is representative of how much money we are going to spend out within the year. Outflow of cash, maybe to invest in new machines, new equipment, so forth. And we will link this with the supporting schedule up from, rather not the supporting schedule, the assumptions section. This one here. And we are saying that the capex, capital expenditures over here, is given to us there. So we link it with that and we press enter. The depreciation is based on the opening PPE always. So pick the opening value of PPE and multiply that with the depreciation rate. Remember, we are saying that we are assuming it for simplicity's sake is going to be straight line method. So depreciation, and we are saying we are going to multiply it with that. And we get that. To get the closing PPE, we are saying we are going to get the opening PPE, we add the capex and less the depreciation on the machines. So we drag the formula moving to the right like that, and we can sort of pull the formula towards the right or drag it. Now the final supporting schedule is the debt and interest schedule here. How do we model it? The debt opening, just like the way we are done in the opening in the depreciation schedule, this value is that value, that value is that value. So it goes without saying this value is going to be that value. So pick it from there. And the issuance and repayment of debt can be gotten from the assumptions section, which is up above over here. So debt and issuance repayment right now here, we link it with that. So here, because it's a formula, we just drag it. So we drag it over here, it's like that. We wait for the plus sign that looks black like that, which is over here like this, and then we sort of drag it. We just drag it moving towards the right. How do we get the interest expense? The interest expense is based on the opening value times interest on the assumptions section. Interest, the percentage of opening balance here is 3%. Now our schedule, or our supporting schedule rather, is complete. That's what we're saying we're going to do. We drag it. These values over here are going to be instrumental towards filling out the cash flow statement. But first, let's go back up and start all over again from the income statement here and fill out what is missing. We have the depreciation component, so we link it with the ones in the supporting schedule. So we go down on here, and you can see the depreciation is given to us over here. There, enter. The interest expense right here, interest expense is linked to the supporting schedule here, right here, enter. Then we can be able to just drag it towards the right there, to R. And in a good account or analyst format, we just make sure that this part is the same color because we've already filled out the missing items, and our income statement is complete. Now, like I said before, that the cash is going to be filled out at the last, at the tail end. It's like the balancing figure. We can fill out the property, plant and equipment. So we're saying it's going to be from the supporting schedules down. So we are saying it's going to be this value here, the closing. You're reporting at the end of the financial year. So we pick the closing balance there, and we drag it towards the right. Remember, it's just the sum of all of them. As well, the debt, we pick the closing debt, which is right here. Closing debt should be that. We can just drag it, Control R. So we can then, of course, now remove the theme color, put it here like so, with the exception of the cash. Now let's fill out the cash flow statement. Net earnings is picked up from above here. Here 35 is here, the net earnings, you can see the net earnings is there. Here we have the depreciation and amortization over here. Right here, so we pick that. And then we are saying changes in working capital. Where do we pick it from? We pick it from the supporting schedules, right here. Change in net working capital, and we are saying we are going to pick that value. So because this is black and it's a formula, I can just drag it like so. Now we're almost there, but we're not there, quite there yet. The investments in PPE represent the capital expenditures. So the capital expenditures down here, capex, you can see the capex is here. Link it to that. And this one, sort of pull it towards the right, and it's complete. As far as the financing cash flow is concerned here, issuance and repayment of debt, we link it with the supporting schedules, rather with the assumptions tab, sorry, up, debt here. And remember, they are following each other with equity. So like that. And this can be dragged like so because it's a formula, and we can complete this by doing that, by dragging the formulas moving the right. The net increase or decrease in cash is a formula because you can see it right above over here. We're going to add cash from operations. We subtract cash from investing because that's money going out, and then we add cash from financing so that you can be able to get the decrease or increase in cash. Drag that towards the right. And we're saying that we can then pick the opening cash balance. Remember, this opening cash balance is the closing cash balance here. This one is that one, and that one is that one. So we are saying that we can then link that with that value. This one is a formula like so. So we can then drag these values moving towards the right, and we have the values like so. Now to try and test and see whether this is actually going to balance, because we are through, answered the statement of comprehensive income, statement of financial position, statement of cash flows, and the supporting schedules. We can see that it's still not balancing. Remember one thing, what I had mentioned, that the cash balance is the one that is the balancing figure right here. So let's try and see if you're going to link it, if it's going to balance. So we link this cash value with the closing cash balance right here, this one here, and you can see it has balanced, but dragging the rest towards the right is the one that's going to tell us whether we are on the right path. And you can see it has balanced very well. The cash flow statement has also balanced as well, meaning that we have successfully answered the question presented to us by Kasneb. We hope that you've enjoyed this session of ours, but before we part, there is one thing that I want to try and see and to ask you, whether even if we change these assumptions here, whether it will still balance. It will still balance. That may be the question. So even if I put this to 25 million like that and leaving the rest the way they are, look at the balance sheet. It still balances. If I put this to maybe 50%, that it still balances. So this issue or this idea of cooking figures cannot arise, because Excel is truthful, and being a true financial analyst means that you need to know how to model all of the three statements: the income statement, the balance sheet, statement of cash flows, very well. Thank you for being with Manifested Publishers, and God bless you.
Hi candidates, welcome to another session of Manifested online classes. We are still continuing the topic of group accounts, and in this session I want us to look on different types of group structure, and basically how we go ahead and prepare the consolidated financial statement in case of those different types of group structure. Now generally we have two types of group structure. The first one is called the horizontal structure, whereby the parent company do have a direct shareholding in a number of subsidiaries, and then we also have another type of a group structure which is called a vertical group structure. So in case of a vertical group structure, this whereby the parent company will be having a direct shareholding in a subsidiary and also having indirect shareholding in something called a subsidiary. So therefore maybe in this case we can say that there are different types of group structure, including number one, we have the horizontal structure. Number two, we have the vertical structure, and also number three, we can talk of the mixed structure, or basically the mixed group structure. So these basically are the different types of group structure. Maybe you can start with the first one, that is the horizontal structure. So when talk about the horizontal structure, this whereby the parent company do have or is having direct shareholding in a number of subsidiaries. For example, in this case, we can be told that A Limited, which is basically the parent company, has acquired some shareholding in B Limited, C Limited, and also D Limited. So mean that the parent company here do have direct shareholding in a number of subsidiaries. So therefore, you can say that this is where the parent company The parent company, remember, also the parent company here is called the investor because it has invested in other entities. The parent company or the investor has a direct shareholding, in two or more subsidiaries, subsidiaries. So the parent company here is having direct shareholding in two or more subsidiaries. So a good example of a horizontal structure, let's assume that we have a limited, and which is the parent company, So this company may have direct shareholding in a number of subsidiaries. For example, B Limited or A Limited may be having 80% shareholding in B Limited. A Limited also may be having something like 60% shareholding in C Limited, and also A Limited may be having like a 75% shareholding in another subsidiary, say D Limited. Now, this particular type of group structure, we refer to it as the horizontal group structure, because you can see the parent company, which is A, is having direct shareholding in 3 subsidiaries, B Limited, C Limited, and also D Limited. Now, in this case, when preparing the consolidated financial statement, we prepare them in the normal way, just like a case whereby the parent company is having a single subsidiary. Basically, what that means is that when preparing the group account, we add similar items of asset and liabilities of all the companies here. That is the parent company, B Limited, C Limited, and also what? D Limited. So therefore, you can say in this case, the group accounts are prepared in the normal way, i.e. by adding similar items of assets, liabilities, revenue, and expenses, of the parent company and its subsidiaries. So therefore, in case of what we refer as the horizontal group structure, the group accounts are prepared in the normal way. Basically by adding similar items of asset, liabilities, revenue, and expenses of all the companies within the group. The group. So let's move and look on the other type of group structure, which is number two, and that is the vertical structure. So in this case, when we talk about a vertical structure, this whereby the parent company is having a direct shareholding in a subsidiary, and then also having indirect shareholding in what we refer as a sub-subsidiary. So therefore, you can say that this is where a parent company is having direct shareholding in a subsidiary company, and also indirect shareholding shareholding in a subsidiary, in a subsidiary. So the parent company here will be having a direct shareholding in a subsidiary company, and also indirect shareholding in what we refer as a sub-subsidiary. So what do you mean by that? Let's assume that we have three companies, and A Limited here, we are told, for example, acquired 80% of the ordinary shares issued by B Limited, and then in turn, B Limited here has acquired a 60% shareholding in another company here, which is called C Limited. Now, this particular type of group structure, we refer to it as a vertical group structure, because the parent company here, which will be or which is A, is having direct shareholding in this subsidiary, and then A Limited, which is still the parent, is having indirect shareholding in C Limited, of which C Limited in this case is referred to as the sub-subsidiary, a subsidiary. Now, when preparing the group account, or basically the consolidated financial statement, in case of a vertical group structure, there are some important points which now the candidate must be able to know, and which basically will help them in terms of preparing the group account of such questions having that type of group structure. So these are some of the important points to note. Number one, when dealing with a vertical group structure, these are some of the important points. Number one is that the candidates must compute the parent company indirect shareholding in the subsidiary. That is the first thing to be done. Compute the parent company indirect shareholding in the subsidiary. Indirect shareholding in the subsidiary. Subsidiary. So how do we compute that particular parent company indirect shareholding in this particular subsidiary? So what we do, we take the parent company shareholding in the subsidiary. So for example, assuming A Limited, which is the parent company, has 80% shareholding in B, which is the subsidiary, and then B, which is a subsidiary, or basically do have a shareholding of 60% in C. So to compute the parent company indirect shareholding in C, we take the parent company shareholding in the subsidiary, which is 80%, and then times the subsidiary company shareholding in the sub-subsidiary, which is 60%. So in this case, or here we are going to get a rate which is 48%. So here we say that the parent company indirect shareholding in C, or basically in the sub-subsidiary, is 48%. But in this case, despite or even if you get a rate which is less than 50%, still we say that the parent company is having indirect shareholding, or basically indirect control in C Limited, simply because A Limited controls this one, A Limited controls B, A Limited controls B, and then B Limited in turn controls C. Controls what? C. And because this controls this one, and this one controls this one, then in this case we say that this company here, that is A Limited, do have indirect control over the operating and financial decisions which will be made by C Limited, and also A Limited will be having indirect control as far as the composition of the board of directors of C Limited is concerned. So therefore, what you are saying is that provided this company is controlling this one and this one is controlling that one, even if you get a rate which is less than 50%, then that company is still a sub-subsidiary. What that means is that when preparing the consolidated financial statement, you have to consolidate, you have to combine, you have to add together similar items of assets, liabilities, revenue and expenses of all the companies. So that is the first thing when dealing with a vertical group structure. Compute the parent company indirect shareholding in the subsidiary. Number two is you need to identify the date, identify the date when the subsidiary became a member of the group. So number two, we can say identify the date when the subsidiary became a member of the group, became a member of the group, became a member of the group. And basically that particular date is very, very important because when, for example, preparing number one, when computing the goodwill of the subsidiary, you compute it on this particular date when the subsidiary became a member of the group. And also when preparing something like the consolidated income statement, you prepare, or basically you take into account the result of the subsidiary from the date it became a member of the group. That is why we are saying it is very, very important for you to be able to identify the date the subsidiary became a member of the group. And actually the subsidiary is said to have become a member of the group on the later of the two dates between the date when the parent company acquired the subsidiary and the date when the subsidiary acquired the shareholding in what? In the subsidiary. So therefore you can say that the subsidiary becomes a member of the group, becomes a member of the group on the later of the two dates, on the later of the two dates. So which are those particular two dates? We are talking of the date when the parent company acquired the subsidiary, and the date the subsidiary acquired the subsidiary. So basically we are saying that the subsidiary will become a member of the group on the later of these two dates. On the later of these two dates. The later of the date the parent company acquired the subsidiary. So like maybe let's assume that you're told A Limited acquired shareholding in B maybe on 1st of January, like 2021, and then B Limited acquired 60% shareholding in C on 1st of January 2022. 1st January 2022. Therefore, in this case, we are saying the subsidiary will be deemed to have become a member of the group on the later of the two dates. The later of the two dates. The date which is later. Basically, the date which is later is basically this one. That is 1st January 2022. So therefore, when computing now the goodwill on acquisition of this particular subsidiary, we compute it on that date. That is 1st January 2022. And also when preparing now the group account or the consolidated financial statement, we must also know that we are going to consolidate the result of that particular subsidiary from that particular date. That is the other important point when dealing with a vertical group structure. Other than computing the parent company direct shareholding in C, you also need to identify the date when the subsidiary became a member of the group, of which you have said it must be the later of the two dates. So the other important point number three, point number three is regarding the cost of investment. Cost of investment in the subsidiary, cost of investment in the subsidiary. So when talk about the cost of investment in the subsidiary, we are talking of the purchase consideration which was paid by the subsidiary in acquiring the shares of the subsidiary. In acquiring the shares of what? The subsidiary. Now, this particular cost of investment in the subsidiary usually is split into two parts. So first of all, we compute the amount due to the parent company, or we compute, yes, amount due to a parent company. So when talk about the amount due to the parent company, this is actually the amount which is regarded or which is assumed to be paid by the parent company in acquiring the shares of the subsidiary. So how do we compute that amount due to the parent company? So this one is computed by taking the cost of investment in the subsidiary. We compute this by taking a cost of investment in subsidiary times the parent company shareholding in subsidiary. A parent company shareholding in the subsidiary. Parent company shareholding in the subsidiary. Like in this case, assuming we are told that B Limited, in acquiring the shares of C, may be paid 100 million. So how do we compute the amount deemed to be paid by the parent company? So we take the cost of investment in the subsidiary, which we are given there as 100 million, and then multiply that with the parent company shareholding in the subsidiary. So the parent company shareholding in the subsidiary is 80%. So in this case, we get what? We get 8 million. So this is the amount deemed to be paid by the parent company in acquiring shares of the subsidiary. And this particular amount which we get here is the one which is then used in the computation of goodwill. So we can say that this is the amount used by parent company in computing the goodwill of the subsidiary So therefore, that this particular amount here, we use it in computing the goodwill of what? Of the subsidiary. Then from there, we also compute the amount of purchase consideration due to the NCI. It is important to note that in this particular subsidiary company here, the parent company is having 80% shareholding, meaning that the remaining 20% of the shares in this particular subsidiary here are held by the minority shareholders. And basically we said the interest of the minority shareholders in a subsidiary, we refer to it as NCI, non-controlling interest. So therefore, what we do next here is to compute amount due to NCI. Compute the amount due to NCI. So how do we compute this particular amount due to the NCI? So we take the cost of investment, in subsidiary, and then we multiply that with the NCI shareholding in a subsidiary. NCI shareholding in the subsidiary. For example, in this case, assuming the cost of investment in the subsidiary is 100 million, so we have to multiply that with the NCI shareholding in the subsidiary. NCI shareholding in the subsidiary is 20%. So this will give us what? This will give us 20 million. So this particular amount of 20 million is then deducted from the NCI at the end of the year. So we can say this is deducted from NCI at the year end. NCI at the year end. So when computing the NCI at the end of the year, so that particular amount due to the NCI, we are saying, will be deducted from what? From the NCI. So therefore, it is very, very important to note that when dealing with a subsidiary, for example, in our case here, C Limited, number one, in computing the goodwill on acquisition of a subsidiary, we have to compute it on the date the subsidiary became a member of the group. Actually, we have mentioned something here to do with identifying the date when the subsidiary became a member of the group, of which that should be the data of the two dates. That is the first important point as far as the computation of goodwill of the subsidiary is concerned. Number two is that when taking into account the cost of investment in the subsidiary, we don't take the full amount. If, for example, B Limited had paid 100 million in acquiring the shares of C, that is not the amount we use in computation of goodwill, but we use the amount which is regarded to be paid by the parent, because it is the parent company here which compute the goodwill on acquisition of C. The goodwill on acquisition of C is not computed by B, because it is important for you to note that in a vertical group structure, here we can say generally we have two parent companies. So A is a parent company to B, and then B is a parent company to C. But this company here, that is B Limited, in accordance with IFRS 10, it is exempted from preparing the group account because it is a partially owned subsidiary by A Limited. The company which is
Welcome learner to our continuing lessons in human resource management. Today we are looking at motivation theories and practice of human resource management, where we are looking at classical theories of motivation, and we are looking at Douglas McGregor theory X and theory Y. Now, this Douglas McGregor is known for proposing theory X and theory Y, which are two assumptions about human nature, and theory X and theory Y on which are theory X and theory Y on how managers perceived and handled employee motivation. The theory X and the theory Y were developed by McGregor in the 1960s. And these theories have extensively been used to inform decisions in management and in human resource management. So what Douglas McGregor did, when it comes to theory X assumptions are the negative sides of the assumptions where some managers had the assumptions about workers. And theory Y is the positive side, according to McGregor, that there are some managers who made assumptions that, for example, in theory X, that employees are inherently lazy. And these employees may dislike work. These employees must be coerced to work. So when managers have that kind of a view about workers, then those supervisors or managers will handle employees with coercion or a dictatorial management style. But on the other side, where an organization, a supervisor or manager views employees with assumptions of theory Y, then the theory Y is the opposite of theory X. And in theory Y, it is presumed that individuals will even like to do work so long as the environment is created to have them to work effectively. And what Douglas McGregor proposed is that managers should emphasize on the theory Y assumptions to be able to create environments that help employees achieve their objectives. So we can have a look at theory Y and theory X, and then we see what were some of the assumptions that were made under theory X and theory Y. So here you have theory X assumptions, theory X assumptions. Okay. Now, when it comes to theory X assumptions, as you have said, Lana, this is the positive side. Okay. This is theory Y, theory X. Theory X is the negative assumptions that supervisors or managers may have regarding workers. And what are some of these assumptions? What are some of these assumptions of theory Y? We have just indicated that in terms of a working environment, a manager may argue that the average worker is inherently lazy. So this kind of a manager makes an assumption that a worker is inherently lazy, for example. 2, dislikes work. 3, cannot take responsibility. 4, should be coerced. Should be coerced. So that means forced. Should be coerced or forced to work. should be coerced or forced to work. 5, will avoid work at all options. So if an employee has an option to avoid work according to these assumptions, a manager assumes that this employee will avoid work at all options, at all options, or maybe opportunity. So these are the kind of assumptions, and these are not all the assumptions. These are some of the assumptions that were proposed by Douglas McGregor, that when you look at a work environment, there are some managers, and these managers may have this kind of assumptions about workers. And when they have this kind of assumptions about workers, then these kind of managers are likely to adopt what is called a dictatorial approach to managing these particular employees within the working environment. Then, on the other hand, there is now the theory X assumptions. Theory Y assumptions. Theory Y assumptions. Now, the theory Y assumptions, this was the negative. So theory Y is the positive side. And when it comes to the positive side, according to Douglas McGregor, employees, the average employee will work willingly. The average employee will work willingly. So what is important is for the management to create a conducive environment. So according to McGregor's theory, when it comes to the theory Y assumptions, what are some of these assumptions? One, workers can take initiative for their work. Two, workers are responsible so long as the right conditions are created. Workers will seek extra, will take initiative and seek extra responsibilities. So what we are saying, Lana, if you look at the theory Y assumptions according to McGregor is arguing that this is the progressive side, and workers can be what is called highly ambitious. Creativity is inherent among the workforce, and so on. So these are the issues. On the theory Y assumptions, if managers make an assumption that the average worker will take initiative for their work, the workers will be responsible so long as the right conditions are created. Workers will take initiative and seek extra responsibilities. Workers are highly ambitious. Workers are willing to be involved in decision making. And when it comes to performance, these employees are able to provide output. So what McGregor provided is that Douglas McGregor, as a note learner, McGregor indicated that it is the responsibility of management to create the right work environment, for employees to operate in. So according to Douglas McGregor, looking at theory X and theory Y, McGregor, Douglas recommended theory Y for progressive managers. So for motivation purposes, McGregor Douglas provided that managers who are progressive should be able to create a conducive environment, and once they create a conducive environment, the assumptions on which they should base decisions on regarding their workers could be the theory Y assumptions, and encourage employees to be able to perform. So those are the issues that surround the theory X and the theory Y assumptions in relation to a work environment. So we can go through this learner slowly again. We have looked at Douglas McGregor theory X and theory Y, and we have indicated that in the 1960s, Douglas McGregor is known for proposing two assumptions about human nature, and these two opposing assumptions were theory X and theory Y, and according to Douglas McGregor, these were the set of assumptions that managers perceived their subordinates or their work environments, and the kind of the managerial decisions they took were influenced by these assumptions. Then we have looked at theory X assumptions and indicated that the theory X assumptions were the negative assumptions that managers could make regarding their employees, and that would then influence the kind of management styles they adopted. And we have seen that the theory X assumptions may include: 1, average worker is inherently lazy; then 2, an average worker dislikes work; 3, an average worker cannot take responsibility for their actions within the work environment; and then 4, an average worker needs to be coerced in order to be able to work, and coercion here we have said is forced. And then number 5, an average worker will avoid work at all options or at any opportunity. So this then will make managers who are managing employees with this kind of a perspective to adopt a dictatorial or autocratic management style. So when workers are handled with that kind of a style, sometimes it may create challenges. So that is as far as the theory X assumptions are concerned. And when it comes to theory Y assumptions, this is the positive side. And the average worker, according to the managers who perceive workers this way: 1, workers can take initiative for their work; 2, workers are responsible so long as the right conditions are created for them; then 3, workers will take initiative and seek extra responsibilities; 4, average workers are highly ambitious; and 5, creativity can be inherent within workers or it can be cultivated. So those are the theory Y assumptions, a set of which some managers may perceive their subordinates and now be able to sometimes adopt what is called a democratic leadership style or management style to be able to get work done. And according to McGregor Douglas, it is the responsibility of management to create the right environment for employees to operate to operate in, and Douglas McGregor highly recommended managers to increasingly adopt the theory Y approach to be able to create a democratic management style to be able to achieve both employee and organizational objectives and motivate workers to their level based in terms of performance. So Lana, before we finish, I want to leave you with an assignment. And your assignment for the lesson today is describe Douglas McGregor's theory Y, theory X, and theory Y. Theory Y as it is used in management. So Lana, this is your assignment. Describe Douglas McGregor's theory X and theory Y as it is used in management. So we have come to the end of our lesson today, where we were looking at Douglas McGregor, theory X and theory Y, and we have looked at the theory X assumptions and theory Y assumptions, and also your assignment. So thank you very much. We hope to meet in the next lesson. Welcome, learner, to our human resource management subject, and we are looking today at Frederick Herzberg's two-factor theory, and we want to look at it in terms of the two aspects two factors presented by Frederick Herzberg. Frederick Herzberg's two-factor theory is also referred to as motivation hygiene theory. And in 1959, Frederick Herzberg proposed a two-factor theory. And according to Herzberg, there are some factors that result in satisfaction, while there are some other job factors that may prevent dissatisfaction. So according to Herzberg, the factors which enhance satisfaction should be maintained, and the factors which prevent dissatisfaction should be addressed to ensure that employees are motivated within a working environment. So Herzberg classified these job factors into two categories, and these two categories are hygiene factors. So you have the hygiene factors. You have the hygiene factors and motivational factors. And according to Herzberg, within a given environment, there could be some aspects built in the job itself. And these aspects that are built within the job itself, according to Herzberg, these are the satisfiers. And that is what Herzberg proposed, that managers have to be able to find out, organizations have to be able to find out what are these inbuilt factors within the job in relation to motivational factors that may enhance employee motivation, and they can be cultivated and they can be put in place, and workers can be encouraged to be able to perform. So we want to look at the two factors. So we will start with the hygiene factors. Hygiene factors. These hygiene factors that were brought out by Herzberg, the hygiene factors are those that may, in the working environment, if they are not addressed, bring dissatisfaction within that particular setting. And Hasberg proposed that an organization has to address those hygiene factors. And what are some of the hygiene factors according to Hasberg? So according to Hasberg, the hygiene factors in an organization may be things like pay. And when it comes to pay, number one, pay. So this could be pay structures, and pay levels. Pay structures and pay levels. So what Hasberg was suggesting, if an organization wants its employees to perform, then they have to look at the hygiene factors in relation to pay. And in this case, you are looking at pay structures, you are looking at pay levels, you are looking at commensurate pay that should be given to employees depending on their performance. Then the next thing could be company policies, organizational policies, organizational policies and procedures. So an organization has to look at the organizational policies and procedures in terms of the guidelines that are available within the work environment that govern the relationship between workers, supervisors, managers, and how work is done in that particular work environment. So when that is now addressed, then there are also aspects of fringe benefits, benefits. So these ones are the extra perks that are provided to workers. For example, an employee in a given organization could be told if they are in an environment where parking is a challenge, that worker could be having a specific area where they park. So when they come to the work environment, they are able to find ready parking. They don't have to move up and down looking for parking. They could, for example, have good physical working conditions. So physical working conditions, physical working conditions should be looked at. So when it comes to the working environment, physical working environment. So this physical working environment may encompass things like maybe the machines, the tools, the equipment that employees are using. So here, machines, tools should be in good condition. Should be in good condition. So if an employee is working and the machine they are using, the employee is using, and the equipment the employee is using is in good order, then that employee will enjoy even doing that particular work. So when you give employees equipment that are current, modern technology, even that worker will want to come and see how they can also be able to use those equipment. Then number 5, you have status. Employees should be recognized. And appreciated. Recognized and appreciated. So if you have designations or titles, then an employee will feel recognized, will feel appreciated, and this can also help in enhancing that employee's, for example, position. Then you also have interpersonal relations, interpersonal relations, interpersonal relations. So this should be cordial. Cordial relations should be cultivated within a given environment. Interpersonal relations, an organization should ensure that the way workers relate to each other, the way they also relate with managers and so on, the way subordinates and superiors relate, that should be cordial relations. Then you have the aspect of job security. Job security. So this could, for example, be given in terms of contracts, stable appointments, among others. So an organization should be able to provide job security, ensure there is work for employees, and that way employees can put in more effort. So this could be some of the hygiene factors which must be addressed within a given working environment to ensure that workers are able to be motivated to be able to work in terms of their areas of operation. Then you have now the second part. That one was hygiene factors. Then you have what we are calling motivational factors. Motivational factors. Motivational factors, or sometimes they were referred to as satisfiers. Motivational factors or satisfiers. So we have looked at the one side. These aspects are not inherent in the job. These are things which are around the job. So Hasberg recommended that in terms of the motivational factors, an organization has to look at the job itself now. The organization has to look at the job itself in terms of how that particular organization is able to work. So in terms of motivational factors, there is the first one, which is recognition. Recognition. So the employees have to be recognized in the organization. The organization, like now, if you have a general manager, you have a maybe plant manager, they have to be recognized within that particular organization, and they have also to be recognized in terms of their accomplishments. Which must also be, which have to be appreciated. For example, an employee has invented some way of doing work that has to be recognized in a function, and if possible, that worker could also be given some reward in relation to that particular recognition, and that one will motivate that worker and other workers to be able to work effectively. And then number two, there is the aspect of sense of achievement. What happens, Lana, human nature is that if somebody does something and there is an element of achievement, right? For example, if an employee is given a target, okay? An employee is given a target, for example, you have got 1,000 acres of land that is arid, for instance, and you put there a team and they are supposed to be able to translate these 1,000 acres into farmland and be able to make harvests from there. So these kind of workers in that kind of a team, they will have a sense of achievement if they achieve this target of translating arid land that is 1,000 acres into arable land that can be able to sustain life and be able to feed people and so on. Then there is the element of growth and promotion. Growth and promotion. So an organization has to provide opportunities for advancement. If workers have achieved, if workers have performed, then these workers should be promoted, for example. So these ones could be, for example, promotion to higher grades, higher grades. So that will make those employees who have been promoted to move to higher grades. It will make these employees to be able to work hard, and other employees will also want to work smart so that they can also grow in terms of their career expectation, as the case might be. And then it is important that employees within organizations are also made responsible. Responsibilities. So we are looking at motivational factors. So if you have a team, for example, if you have a team and you make them responsible for production, for example, responsible for production, so they will set targets, they will bring together their schedules, they will decide when they are supposed to maybe stop the machine and do overhaul. And when they have those responsibilities as a team, if they achieve or if they are challenged to be able to achieve challenging targets and so on, then that particular kind of a group can be able to operate, can be able to be motivated in terms of a team, in terms of the members and so on. Then there is the element of meaningful work. Meaningful work. So that work should be worthwhile. Whatever employees are doing should be worthwhile, something they can be proud of. For employees to be proud. Employees should be proud of what they are doing. If they are doing things that are making lives better, if they are doing things that are changing the environment, that are changing the society, they are, for example, producing products that are being used to save lives. They are making products which are used to feed people who are hungry, dress or clothe people, provide intervention measures and so on, assist humanity. So this meaningful work will make it worthwhile, and it is a motivational factor for employees, and it is one of the satisfiers that management has to make sure within a given work environment, employees are motivated. So having looked at now hygiene factors, we have also looked at motivational factors. What are some of the implications of two-factor theory? Implications of two-factor theory. Implications of two-factor theory. So we want learner to look at what are some of the implications of the two-factor theory. So one, managers and supervisors must create a conducive work environment for effective motivation. Two, employees should be involved in decision making. Number three, why this Frederick Herzberg's two-factor theory is critical. Jobs must be designed. To enhance employee motivation. So what you are saying, Lana, in this point is that if you look at the hygiene factors, these are factors which are outside the job. But if you look at the motivational factors, these ones are factors which are inherent within the job. Then progressive recognition should be made to employees should be made to employees to encourage motivation. So you have a situation where employees have performed well, and it had been agreed that if you achieve, it is important that you are recognized. So the recognition should be made. And number 5, organization should combine intrinsic and extrinsic rewards. Organizations should combine intrinsic and extrinsic rewards in their motivation. So what happens, it is not only the extrinsic factors, intrinsic and extrinsic factors are important. So organizations must seek to strike a balance in terms of how they may want to motivate their workers. And then it's also important, number 6, job enrichment. Job enrichment should be used to provide employees with vertical job loading factors, to motivate workers, through challenging tasks. So Lana, these are just some. Job enrichment should be used to provide employees with the vertical job loading factors. So here is where higher level tasks are brought down to encourage employees to be able to perform in a given organization, to achieve that sense of achievement for the meaningful of the work, so that the work is also exciting. So Lana, summary of Frederick Herzberg's two-factor theory. We have looked at Frederick Herzberg's two-factor theory, and we have indicated that Frederick Herzberg's two-factor theory may also be referred to as motivation hygiene theory. It was proposed in 1959 by Frederick Herzberg, and according to Herzberg, there are some job factors that result in satisfaction, while there are other job factors that prevent dissatisfaction, and Herzberg classified them as hygiene factors and motivation factors. We have had a look at some of the hygiene factors, and we have indicated that some of those hygiene factors are pay, where you are looking at pay structures and pay levels. We also have hygiene factors like organizational policies and procedures and guidelines. We also have fringe benefits or extra perks, number 3. Number 4, physical working conditions like machines, tools should be in good conditions to facilitate smooth working. Number 5, status, where we have said that employees should be recognized and appreciated. Number 6, interpersonal relations should be cordial. Number 7, job security should be provided to workers where they are appointed in contracts that are stable. So Lana, those are some of the hygiene factors. Then when it comes to motivation factors, which we have indicated like satisfiers, number 1, there should be recognition, where employees should be recognized for their accomplishments and appreciated. Number 2, sense of achievement, where workers are given targets that if they achieve, they also feel they have conquered and achieved something. Number 3, growth and promotion opportunities should be provided to workers. Then number 4, responsibilities, where team production could, for example, be encouraged. Number 5, meaningful work should be made available, where workers feel that it is worthwhile to be able to perform those tasks. Then we have also looked at the implications of the two-factor theory, and we have indicated that it has several implications, including, number one, managers and supervisors must create a conducive work environment. Number two, employees should be involved in decision making. Number three, jobs must be designed. Jobs must be designed to enhance employee motivation. Number four, progressive recognition should be made to employees to encourage motivation. Number five, organizations should consider combining intrinsic and extrinsic rewards in their motivation processes. And number six, job enrichment should be used or provided to employees with vertical job loading factors to ensure that workers are able to perform higher level activities, to challenge them and to give them an opportunity to make a contribution and feel that their knowledge and skills have been applied. So before we finish, you have an assignment, learner. Assignment. And your assignment today is assess the application of Hasberg's Frederick Hasberg's two-factor theory in human resource management. Human resource management. So learner, that is your assignment. Assess the application of Frederick Hasberg's two-factor theory in human resource management. So I want to take this opportunity to thank you very much for being attentive in our lesson today. Thank you.
Hi student, welcome to another session of Manifested Online Classes. So in this class, I want us we continue with the topic number 1, and that is accounting for asset and liabilities. And in this session, I want us we look on the subtopic accounting for leases at IFRS 16. So as far as this particular topic is concerned, we're going to look on a number of issues, or basically we're going to discuss a number of issues. One, we're going to define what is a lease. Number 2, we are going to look on the various types of leases, or various ways in terms of how leases are classified at IFRS 16. And then from there, we also look on how leases are accounted for by the various parties in a lease, because in a lease, we have a number of parties, actually 2 parties. We have the owner of the asset, who is called the lessor, and then we have the other party who has been given the right to use the asset and who is called the lessee. So therefore, those are majorly some of the issues we are going to discuss as far as this particular topic is concerned. So to start with, I want us we define what is a lease, and basically when we talk about a lease, this refers now to a contract, or basically part of the contract which conveys, or basically which gives the right to use an asset to another person for a specific period of time in return of some consideration or in payment of a consideration which is known as the minimum lease rental. So therefore, it is that particular contract whereby one of the parties will be given out the right to do what? To use the asset for a specific period of time in return of some periodical payment. So therefore, here we can say that a lease is a contract Yes, so therefore in this case we are saying that when talk about a lease, basically we are saying that this is a contract, or basically part of the contract that conveys, or basically that gives the right to use an asset for a specific period of time in return of some periodical payment or in return of some periodical payment which is known as the minimum lease rental. So therefore, it is basically that particular contract whereby the owner of the asset will be able to give the right to another person to use an asset for a given period of time in return of some periodical what? Payment. And basically we are saying that those periodical payments, we refer to them as the minimum lease rentals. In very simple terms, when we talk about the minimum lease rentals, we are talking of the rent now which is supposed to be paid to the person who has been conferred or basically who has been given the right to do what? To use an asset for a specific period of time. And therefore, it is important to note that in a lease contract, basically we have two parties. We have two parties. We have the owner of the asset, who in other terms we refer to as the lessor, and then we have now the person who has been given or who has been conferred the right now to use what? The right to use an asset. Therefore, we can say here that in a lease, we have two parties. So we can say that there are two parties. There are two parties involved in this contract. And those two parties include who? Number one, we have the person who owns the asset, the owner of the asset. And basically the owner of the asset, we refer to this as the lessor. And then number two, we have the person who has been conferred or basically given the right to use an asset, and basically that particular person is called the lessee. The lessee. So therefore, the owner of the asset is called the lessor, and basically this is a person who will have conferred, who will have given the right to use an asset to another person who is called the lessee. Now, in this particular case, we have various ways in terms of how leases are classified. In accordance with this particular standard here, that is IFRS what? IFRS 16. So number one, we have something called a finance lease. Number two, we have something called an operating lease. And then we have something called a short-term what? A short-term lease. So therefore, we can look on the types of leases or basically the various ways in terms of how leases are classified, types of leases. Number one, we have what we refer to as a finance lease. Some books refer to this as a capital lease, lease. And number two, we have what we refer as an operating lease, And then number three, we have what we refer as the short term. What? So therefore, leases are classified into those three what? Categories. Now, first of all, when talk about a finance or basically a capital lease, we say that these are particular leases which transfer substantially all the risk and rewards associated with the asset to the person who is called the lessee. So therefore, that particular lease there, the risk and also the rewards associated with the asset will be transferred to the person who is called the lessee. So therefore, we can say that a finance lease, which is also known as a capital lease, we are saying that this is a lease. This is a lease which substantially transfers all the risks and rewards associated with the asset to the lessee. So meaning that this particular type of the lease here will transfer all the risk and rewards associated with the asset to the person who has leased the asset. Basically, what that means is that if, for example, you lease an asset from the owner, any benefit or basically any reward which is associated with that particular building, for example, the rent which is being generated by that particular building will have now to be collected by you as the lessee. And number two, the risk associated with that particular building will also be transferred to you. It basically means that you have the responsibility to insure that particular what building, because if something happened to that particular building, like the building is damaged and something like that, then you have the responsibility to do what? To repair that particular building. So that's why we are saying you have the responsibility to ensure that the building is actually what? Is actually insured. So that in this case, we say that the risk and also the rewards associated with the asset are transferred now to the person who is called the lessee. So number two, we have the other type of the risk, and that is operating risk. Operating risk. So when talk about an operating risk, this is actually defined to be any other risk. This is defined to be any other risk other than finance what risk. In other terms, what that means that under finance, or basically under the capital risk, the reward and also the risk which are associated with the asset are not transferred to the lessee. So therefore, we can say that this is any other risk Yes, so therefore, in this case, we are saying that this is any other risk other than what? The finance, or basically the capital what? Risk. And therefore, in this case, we have said that the risk and also the rewards which are associated with the asset are not transferred now to the person who is called the lessee. And then from there, we have the last type of the risk, which is called the short-term risk. The short-term risk. When talk about the short-term risk, this refers to any risk whose risk term basically do not exceed 1 year or do not exceed 12 months. When talk about the term of the risk, we are talking of the period of time when the lessee has been given the right to use the asset. So mean that if you lease an asset from the owner and the agreement is that you should use that asset for a period of time which does not exceed 1 year or basically 12 months, then we refer to that as what? As a short-term what? Risk. So therefore you can say that this is a risk whose risk term does not exceed 1 year. Does not exceed what? 1 year, or basically does not exceed what? 12 months. But the two main classification of risks under this particular standard here, that is IFRS 16, is what referred as the finance risk, or and also what referred as operating what risk. So mean that for accounting purpose, the two main ways in terms of how risks are classified is the capital, or basically what the finance what risk. So therefore, that is the first thing you need to know. You need to know what is a risk, which you have said is basically that particular contract whereby the owner of the asset will be able to confer, will be able to give the right to use an asset to a person who is called the lessee, and basically the lessee is supposed to pay some periodical payment, which we have referred to as what? The minimum risk rentals. Equally, we have said in a lease contract, we have two parties. We have the owner of the asset, who is called the lessor, and then we have the person who has been conferred the right to use the asset, who is called the lessee. And then in this case, equally, we have said that leases are basically classified in three main what categories. So actually, we have said we have two main categories: a finance risk, and then from there we have what? The operating risk. Then from there, I want us to look on how risks are accounted for by the person who is called the lessee. So by the person who is called the lessee, so we can look on what we refer as accounting for risks. Accounting for risks by the lessee. By the lessee. So first of all, who is the lessee? The lessee in this case, we have said, is that particular party, is that particular person who has been conferred the right to do what? To use the asset for a specific period of time, and then he is supposed to do what? To pay some periodical payment. Now, one of the important points to note here, as far as accounting for risks by the lessee is concerned, is that the lessee, in accordance with IFRS 16, should not classify the risk as an operating risk or a finance risk. So basically what that means, that classification of the risk as an operating or finance risk, it only applies to the owner of the asset. The owner of the asset is who? Is the lessor. So therefore, that is the first important point, that the lessee the lessee should not classify the lease a lease contract as an operating or the finance lease. The finance what? It is, and basically I've said that this is a requirement of IFRS 16. It is also important maybe to note at this point that IFRS 16 is basically a new standard which was issued to replace the old standard on leases. The old standard on leases was IS 17, International Accounting Standard number 17, and that particular standard had given the lessee the option to classify the lease as an operating or basically what? Finance lease. And therefore, what most of the companies were doing after leasing asset, most of the company were accounting for those particular leases as operating leases. So what that means is that most of the companies were avoiding showing liabilities in their books of account by accounting for the leases as what? As the finance leases. Because once a company leases an asset for a long period of time, the company should be able to show the liability which will be in form of the lease rentals to be paid over the lease term. But what I'm saying is that at the IS 17, most of the companies were avoiding that, showing liabilities in their balance sheet, and therefore they were classifying for all leases as operating what? Leases, whereby companies were only accounting for the lease rentals which was paid in a certain financial year as an expense. But now, this particular standard here, IFRS 16, considered that as a limitation associated with IS 17, and basically now IFRS 16 prohibit now the lessee from classifying the lease as an operating or what? A finance lease. And therefore, once a company or basically an entity leases an asset, what that particular entity should recognize in its books of account are two items. Are two what? Items. Number one, we have something called the lease liability, and number two, we have something called the right of use what? Asset. So therefore, we can say that on initial recognition, the lessee should recognize or basically record number one, right of use asset, and number two, something called the lease liability. Something called the lease what? Liability. So these are the two items which now the lessee is expected to initially record in his books of account once now the lessee has leased an asset. Has leased what? An asset. Therefore, in this particular case, what we are going to look, we are going to look on how we determine these two items. How do we determine the right of use asset? And number two, how do we determine the lease what? Liability. So I think we can start by looking on how we determine what if is the lease liability. Lease liability. So the lease liability, essentially, this represents the present value of the minimum lease rentals which now the lessee is expected to pay. So basically what that means is that if, for example, you lease an asset and you lease that asset for the next 5 years, then there is the minimum lease rentals you should be paying annually. Remember, in this case, you have said the minimum lease rentals is the rent to be paid on annual what? Basis. So therefore, for you to be able to determine the lease liability, what you do, you have to discount, or basically you have to get the present value of the minimum lease rentals you are going to pay over the lease what? Term. And therefore, in this case, we can say that the lease liability, this is equal to present value of minimum lease rentals not paid not paid at the inception date, at the inception date of the lease, inception date of the lease, discounted using the interest rate implicit in the lease, interest rate implicit in the lease, implicit in what? In the lease. So therefore, for us to be able to determine the lease liability, what we do is that we get the present value of the minimum lease rentals, which is not paid at the inception date of the lease. So basically what that means that in getting that particular present value of the minimum lease rentals, we do not take into account, we do not include any minimum lease rentals which is paid at the inception date of the lease. Like maybe we take a small illustration here. We are told that a company leased an asset, and that company is supposed to pay a minimum lease rentals. Remember, in this case, we have said that when we talk about the minimum lease rentals, we are talking of the rent now to be paid by the company on annual basis. So we assume that that company is supposed to pay maybe an amount of 100,000, and you are told that this particular rent is payable in advance. Is payable in what? In advance. So being payable in advance, that means that the rent for each financial year is supposed to be paid at the start of each year. At the start of what? Each year. And also we assume that we are told that the lease term, so in this case when we talk about the lease term, basically we are talking of the period of the lease. The lease term maybe we are told are 4 years. Are 4 years. Also, in this case, the examiner will have given you something called the interest rate implicit in the lease. So we'll talk about the interest rate implicit in the lease. This is the rate now which you should use for discounting purpose, because in discounting, in getting the present value, you must be having an R. So R is now what? The interest rate implicit in what? In the lease. So let's assume that we are told that the interest rate implicit in the lease, maybe is 10%. Is 10 what? Is 10%. Now, in this case, how do we determine the lease liability? How do we determine the lease liability? So we are saying the lease liability will be equal to the present value of the minimum lease rentals not paid at the inception date of the lease. In this case, when we talk about the inception date of the lease, we are talking of the date when the lease commenced. We are talking of the date when the lease commenced. So in this case, maybe we can have a schedule here, a certain schedule. So we are saying our lease here is for how many years? For 4 years. So this will be year 1, year 2, year 3, year 4. So how much rent is supposed to be paid annually? So we know that the rent to be paid annually here is 100,000, and basically you say that this should be paid at the start of each year. So what that means is that the first rent will be paid at the start of year 1. Basically the start of year 1 we refer to that as time 0. The other rent will be paid at the start of year 2. The other rent will be paid at the start of year 3. And the other rent now will be paid at the start of year what? Year 4. So to determine the lease liability here, we are saying that this will be equal to the present value of the minimum lease rentals not paid at the inception date. Not paid at the inception date. So not paid at the inception date. So in this case, when we talk about the lease, minimum lease rentals not paid at the inception date of the lease, we are talking of the rent now which was paid at the start of year 2, at the start of year 3, at the start of year 4, because this particular amount here was paid at the inception date. At the inception what? Date. So therefore, let's determine the lease liability, which will be equal to 100,000, which is now the minimum lease rentals. And then what we need to do, we need to discount that. So how do we discount this? We discount this by multiplying that with the present value, interest factor of annuity, At which rate? So this 10% will be our R at the rate of 10%. And then in this case, we are discounting the rent which was paid at the start of year 2, at the start of year 3, and also at the start of year 4. So therefore here, we consider rent for how many periods? 3 periods. Or basically, yes, 3 periods. So therefore, here our N will not be 4, but rather our N will be what? Will be 3 years. Because in this case, we are saying this particular lease rentals which was paid at the inception date of the lease does not form part of the liability. Does not form part of the liability. So therefore, we take 100,000, and how do we compute that? To compute this, there is a formula which we apply here. We take what? We take 1 minus 1 plus R. Our R in this case is 10%, so this will be 1.1 raised to power negative 3, and then we divide that with R, which is 0.1. So whatever we get here, this is now what referred as there is liability. There is what? Liability. So therefore, it is important here to note that there is liability. Basically, this is the present value of the minimum lease rentals, which is not paid at the inception date of the lease, because the amount which has already been paid at the inception date of the lease, that does not form part of the liability. Does not form part of the liability. So, and then we discount that using what we refer as a interest rate implicit in what? In the lease. And then once we have determined that particular lease liability, then what we should do, we should be able to amortize that. We should be able to do what? To amortize that, because now whatever you are going to get here as the lease liability, it basically represent the present value of what now the lessee is expected to pay over the lease term. So basically what that means that at the end of the lease, then the lease liability should be what? Should be 0. But we are going to look on how we do that particular amortization, specifically when looking on an illustration what? A question. So then from there, we can proceed and look on how do we determine the other items there. Remember, in our case here, we have looked on how we determine the lease liability. So next, I want us we look on how we measure, how we determine the value of what? Of the right of use asset. So let's look on how we determine that. That is the right of use asset. So we have right of use asset, right of use, abbreviated as ROU, right of use asset, right of use asset. So to determine this, basically we add like 3 items. We add 3 items. One, we take the what? The present value of what we refer as a minimum lease rentals, present value of minimum lease rentals at inception date of the lease, and then now to this we add payment. So to that we add what? The payment made before or at the inception date of the lease. So when we talk about this payment made before or at the inception date of the lease, we are talking of any rent which was paid at the date when the lease commenced. For example, from this particular small illustration which I've given you here, so this particular amount of 100,000, this is a payment which was made at the inception date of the lease. So take into account that. And then to this we also add any initial direct cost, e.g. what we refer as the legal cost. So in this case, when we talk about the legal cost, anytime as a company or as an entity you lease an asset from the owner, then you must have a lease agreement drafted by you, or basically you must enter into a lease agreement. So that particular lease agreement will be drafted by a lawyer who definitely will have to charge you a fee. So that particular fee, which will be charged by your lawyer, we refer to it as what? As a legal cost, which is basically an initial direct cost, which is associated with what? With the risk. So therefore, what we do, we add all this, and basically whatever you get here is the amount for initial recognition of what we refer as the right of use what? Asset. And then once this particular value has been determined there for the right of use asset, then subsequently it must be depreciated on a straight line what? Basis. So therefore you can say that the right of use asset must then be depreciated, Yes, so basically what you're saying is that this right of use asset must then be depreciated at the shorter of two period. At the shorter of two period, one what we refer as the lease term, and what we refer as the economic life of the asset. So like assuming you are told that the lease term, or basically the term of the lease, 4 years, and then you are told that the economic life of the asset are 5 years, So therefore, you depreciate this right of use asset at the shorter of these two periods. You take the period which is shorter out of the two periods. So in our case, the period which is shorter, 4 years. So what you do, you take the value you have determined here, and then you divide that with 4 years. Whatever you are going to get now is the depreciation per what? Per annum, of which that particular depreciation should be recognized by the receipt here in the income statement as what? As an expense. As what? As an expense. So therefore, it is important to note that according to this particular standard here, IFRS 16, it prohibits the receipt from classifying the lease as a finance or an operating lease. This standard requires that at the inception date of the lease, once an entity or basically a company leases an asset from the owner, that company should recognize two items in the books of account. One is what we refer as the lease liability, which you have said is equal to the present value of the minimum lease rentals not paid at the inception date of the lease. And then we have said that that lease liability should be amortized over the lease term. And two, the lessee should be able to recognize something called what? The right of use what? Asset. The right of use asset is basically determined by adding these three items: the present value of the minimum lease rentals at the inception date of the lease, plus any payment made before or at the inception date of the lease, plus any initial direct cost associated with the lease. And then you have said that that right of use asset should be depreciated at the shorter of two what? Two period. That is now the lease term and also the economic life of what? Of the asset. But in this case, we have two exemptions, or basically two instances or two circumstances whereby the lessee is exempted from recognizing those two items in his books of account. So mean that at a number of circumstances, the lessee is not required to recognize the right of use asset in his books of account, and what he refer as the risk what? Liability. Risk liability. So which are those exemptions? Which are those exemptions? Exceptions. So basically we refer to them as exemptions or exceptions from complying with IFRS 16 as far as accounting for leases by the lessee is what is concerned. One of the exception is in case of what we refer as the short-term lease. The short-term lease. Remember, we defined what is a short-term lease, and we say that these are leases whose lease term does not exceed 1 year or does not exceed what? 12 months. So whenever a company leases an asset and the company has leased that particular asset for a period which is less than 1 year, that company do not necessarily need to recognize the right of use asset and also the lease liability in its books of account. So such a company will just account for the rent which was paid as an expense in the income what? Statement. Number two, or the other exception, is in case of what we refer as arrears of an asset, of low value, and a good example of this is arrears of a personal computer, of a personal computer. So if a company leases such an asset, e.g. a personal computer or even a laptop, which is of low value, that company do not need to recognize the right of use asset and what there is liability, but the company will just need to recognize the amount which is being paid as a result of having leased that particular what asset as an expense, as an ordinary what expense. So therefore, those are the two exemptions, or basically the two instances, two circumstances whereby the lessee is not required to fully comply with the requirement of IFRS what 16 as far as the accounting for leases are what are concerned. So therefore, that what you need to know as far as the accounting for leases by the lessee is concerned. I want us we take a short break, and then once we come back in our next class, I want us we look on an illustration regarding accounting for leases by the lessee. And then once we do that particular illustration, we are going to proceed and look on how we account for leases by the other party, and that is the owner of the asset, or the lessor. So therefore, we take a short break, and then we meet in our next class.
Hi there, my name is Patrick Kamau Kamure. You are lecturer in advanced taxation. So I welcome you today to the lesson where we look at a topic called tax investigation. And under the tax investigation, we are going to look at the back duty and in-depth investigation. So when we talk of the back duty, we are talking about the tax that is in arrears or that was in arrears. Back duty, you know, the tax, the duty that is backward, the one that was supposed to be corrected by the KRA from the taxpayer, but it wasn't corrected. So what the KRA normally do, they normally come and look at your books of account, and they do a thorough investigation in order to determine your tax position. So in this case, we want to see how is that investigation usually done. In this case, what you also need to understand is that when you talk of the back duty or the tax that is in arrears, and in which case an in-depth investigation is usually done. So in this case, what normally happens is that KRA usually have to come and look at your books of account and determine the taxable income. The taxable income of each of the years. So taxable income in that, if for example you are under investigation for 5 years, so they have to determine what is the taxable income of the first year, what is the taxable income of the second year, third year, fourth year, and the fifth year. And once they determine the taxable income of each of those years, then they multiply by the tax rates. If it is a company, 30%, and then they can be able to get the tax that you are supposed to pay. If you are an individual, then it is graduated, because we know that individuals, it is usually on graduated scales. So it is graduated to determine now the tax that you are supposed to pay. So in this case, we should ask ourselves then, what normally costs the tax that is in arrears? What normally costs the back duty? It is usually as a result of majorly 3 things. One, non-declaration of taxable income, where the taxpayer didn't declare the taxable income for those particular period at all. So the KRA would have come and now determine the taxable income for each of those years. 2, under declaration of the taxable income. It means that you didn't declare the correct amount of the taxable income. For example, you have been earning, let's say, 100,000 per month, but instead of declaring that, and remember we normally declare when you are filing the returns, instead of declaring the 100,000, you declare 50,000 every year. So that means that the KRA will tax you on 50,000. So the 50,000 that you have not declared, that would amount to the back duty when it is taxed. So another one we have where the taxpayer have been over declaring the allowable expense of the business. So remember, expenses normally reduce the taxable profit or income of the business. So if the expenses are overstated, then the taxable profit automatically will come down. So in that case, that means that if the profit is less, then the KRA will come and investigate. Why have you been under declaring the over declaring the allowable expense or under declaring the taxable profit? So in this case, then that means that when they do the investigation and determine the correct amount of the expense you are supposed to deduct, because now you have been over deducting, then that means that this would amount to the tax in arrears, or what we call the back duty. Now, when the in-depth investigation is usually done, the KRA normally use one item to do that. We call it the capital statement. And capital statement, as we are going to see, it is used when we have more than 1 year. The taxpayer has not been declaring their taxable income for more than 1 year, and we are going to see how that capital statement is used to determine the taxable income of the taxpayer. So before we go very far, I'd like us to write something on that. That back duty refers to the tax in arrears. In arrears, that is the tax that was supposed to be paid in the past years. But it was not paid. The tax in arrears is usually determined using by the KRA, determined by the KRA by doing an in-depth investigation. In-depth investigation is where KRA take a look at all books of account of the taxpayer to determine the correct tax position. Another point is that back duty stroke tax in arrears can be as a result of the following. 1, non-declaration of taxable income. Number 2, under declaration of taxable incomes. Number 3, overstating of allowable expenses of the business. And the last one I want to add here is claiming expenses or relief one is not entitled to. One is not entitled to. So another point that you need to know is that when determining the tax in arrears stroke back duty the commissioner will determine the taxable income of each year from where the tax in arrears will be computed through computation of taxable income and tax rate applicable for the years of income for the taxpayer and the year of income. We say another one is that determination of taxable income where investigation involves several years is done using capital statement. So it's good to know we have talked about capital statement there. And we say capital statement is used where no proper books of account have been kept by taxpayer. It involves comparison of assets and liabilities of business to determine the capital or net assets or net assets or net assets, after which growth in capital or net assets is used to determine taxable income. Capital statement which is used to determine the taxable income has the following format. So I already have explained to you what that means. However, we are saying now, where no proper books of account have been kept, the taxpayer normally use the capital statement, or KRA will use the capital statement to determine the taxable income of the person. Now, once they get the taxable income, then they'll just compute the tax payable by multiplying with the corporate tax rate or the graduated scale rates for the taxpayer. In case it is an individual like those in sole proprietorship or those in partnership. So we are saying that capital statement is usually prepared by comparing assets and liabilities to determine the capital or the net assets, after which the growth in capital or growth in net assets would then be determined, and from there now the taxable income would be determined. So capital statement, we are saying, has the following format. So I'm going to draw for you the capital statement there, see how it is used to get the taxable income. So I leave this space because of the structure of the capital statement, and utilize the space on the other end. So this is how capital statement look like. We have the capital statement. We have the items, and then we have years, which we have year 1, year 2, year 3, year 4. So this will be writing the figures . And so we usually start with the total assets. Total assets. For the total assets, let me write them this way. We start with the total assets. Total assets. So total assets of the business, which we list them here, year 1, year 2, year 3, year 4. And then we less total liabilities. Total liabilities we have for each of the year. Year 1, we less. And that will give us capital. Will give us the capital at end of the year. Capital at the end of the year, we have this for each. Then we less capital at the start of the year. Of the year. And that will give us the growth, let me write in short, growth in capital or net asset or net accounting profit. Net accounting profit, which will have the amount. Then we add non-allowable expenses. Non-allowable expenses for each of the year. And then we less capital allowance and non-taxable incomes. And that will give you, it will give you the net accounting profit there. So that is how the capital statement look like. We have the name, and then this where you can see we are listing the item, and we list the years, year 1, 2, 3, 4. So what we usually do, we start with the total assets of the business. And when we talk of the total assets, take note we are talking about all the assets of the business, both private and commercial. So not that we may say that because we are looking at the taxable income of a business, we only take for the business only. No, we take the business and the one that are for private, non-commercial. Why are we considering the private? Because it's assumed that this person got the money from the business to finance his private asset. So that's why you take all the assets of the business. And then you raise the total liabilities of the business. Why are we minusing total liability? Which means both business and non-business liability, because this is the owner of the business, and what he's doing is that he cannot be able to differentiate the business, the income, the money that he borrowed for the business and the one he didn't borrow for the business. He can borrow not for business and bring the money into the business. So that's why we consider all the liabilities. So for each of the year, then when you compare the assets minus liability, it will give you the capital at the end of the year. So what we mean is that these assets must be at the end of the year, liability at the end of the year, so that it will give you capital at the end of the year for each of those years. And then you raise the capital at the start of the year. So when the year was starting, how much was the capital? So you come and post it here, post. Now when you say the capital at the end of the year minus capital at the start, it normally gives you the growth in capital or net assets or net accounting profit. Because if, for example, at the end of the year you have 200 million, let me use another current so that you can be able to see. Let's say you had 200 million here, and then that is at the end of the year. At the start of the year, you had 150 million. So it means that now the capital grew by 50 million to 200 million from 150. So the 50 million is the growth in capital, which we normally post there. Now, once you get the growth in capital or net assets or net accounting profit, then you know this net accounting, you know, an accounting profit where now you can use the net profit method to get the taxable income. Net profit method means that we add non-allowable expenses. So non-allowable expense for each of the year, and then you raise the capital allowance. So here you should have added non-allowable expense. One of the non-allowable expense we have run so far is the depreciation. So depreciation you should have disallowed, but now in taxation we allow capital allowance. So we deduct it here. And also if there is an income that is not taxable. And when we talk of taxable, we talk of non-taxable, we mean those that are investment and the operating income, the one that are not taxable. So like now, dividend and interest from abroad are exempted from tax. Interest from a bank for an individual, withholding tax is final. So those that are final and exempt, don't tax them, so we should remove them. So when you take this figure, net accounting profit, add non-allowable less the capital allowance and non-taxable income, it will give you the net taxable profit. So in this case now we can go ahead and tax those particular profit on those that particular person or business. So that is how we prepare the capital statement to determine the taxable income. However, it's also important for you to note that if you are given the capital at the end of the year, then you don't have to compare the assets minus liability. You just take the capital at the end of the year, and then now you continue from there at the end minus at the start, and then you continue at the end. So I want us to look at a question to see what we are talking about, the back duty using the capital statement. So I'll have to rub what I have written here so that we can have a space to do the question. This is what the question says. Johnson Shauri has not been maintaining proper books of accounts since the inception of his business in the year 2019. The following balances were obtained from the available business records for 4 years period ended 31st December 2022. So we have the years 31st December 2019, 2020, 2021, and 2022, which we have leasehold property, motor vehicle, furniture, a bank overdraft, loss on sale of investment, account receivable, mortgage loan, inventory, computer, bank account, personal clothes and effects. The following additional information was obtained. Drawings of goods and provision for taxation for the year 2019 were 600,000, 360,000 respectively, and had been accumulating at the rate of 10% annually. A capital allowance were agreed at a total cost of 920 for each of the 4 years. Donation to a political party in the year 2020 amounted to shillings 142,000. Gifts from relative for the year 2021 were 840. Contingent liability in respect of a pending court case in the year 2022 was 1 million. Rent paid on behalf of a close friend was 605,000 in the year 2022. Living expenses were estimated at 800,000 in the year 2019 and had been increasing at the rate of 15% cumulatively each year. We are required, number 1, compute the taxable income or loss of Johnson Shauri for the year ending 31st December 2020, 2021, and 2022. Summarize 3 specific actions that the tax practitioner could undertake upon discovery of an irregularity in the client business. So first we want to get the taxable income, and in this case you can see we have been given several assets of the business, several liabilities of the business, and we are given them the years. There are several years, so we are supposed to get the taxable income for them for the 3 years. So that is 2020, 2021, and 2022. However, now we are also given the column for 2019 because we haven't given the capital at the beginning of 2020. Actually, if you are given the capital for each of the year, in that case we should now start from the capital, and now we continue from there. But we are given the assets and liability, so we need the capital at the beginning of 2020, which is the first year of determination of the taxable income. So we need a column for 2019 where we take the assets minus liability to get the capital by the end of 2019. Once you get the capital by the end of 2019, then we can be able to use it in the 2020 as the capital at the beginning of 2020. So this is how the capital statement should look like. So we'll start with the total assets. We list them. The leasehold property is the first one. Which we have 11,760. 11,760 across the board. Motor vehicle. We have 50/40. Furniture. Then we have the loss, bank overdraft, that's a liability. Loss on sale of investment, that is an expense. Account receivable is another. Then mortgage loan, that's a liability. Inventory is another. $620, $572, $482, $520. Then we have computers. $620, $720, $840, $720. Bank account is another. $240, $268, $272, $286. Personal close and effects, those are supposed to be asset as well. Personal effects. Personal close and effects. $60, $80, $100, $120. So we need to get the total. Before we do that, we also need to look for the total liabilities. Total liabilities, which we have the registered no motor vehicle furniture bank overdraft. Bank overdraft where we have 1288, 1400, 1210, and 15. The other one is mortgage loan. $2080, $1840, $1620, and $1500. Those are the liabilities that we have. So we need to get the total. Except there was one more liability, sorry. In the point number 5, there was a contingent liability. Already you are told it's a liability contingent one. So contingent liability. Which we have 1,000 in 2022. And yeah, those are the one that we have. So we'll get the total. We will add them starting from here. So we have 11,760 plus 5040 plus 864 plus 432 plus 620 plus 620 plus 240 plus 60. 19,636 The other one is 11,760 plus 4720 plus 864 plus 544 plus 572 plus 720 plus 268 plus 80, 19,488. The other one is 11,760. We add 9360. We add 864. We add 48. We add 482. We add 840. We add 272. We add 100. 24,086. Go to the last one, 11,760. We add 10,760. We add 864. We add 600. We add 520. We add 720. We add 286. We add 120. We have 25,630. Then we come here, 1288. We add 2080, which will be 3368, and then 1400, and we add 1840, which will be 240, 1210 plus 1620, 2830. Then we have 15 plus 1500 plus 1000. That's 615. So now we get the capital at end of the year, which will be now the asset minus liabilities. So for the first one, it will be 19,636, and then we minus 3368, which give us 16,268. The other one will be 19,488 minus that 240, which gives us 16,248. The other one is 24,086, and we minus 2830, 21,256. The other one is 25,630, and then we minus that 615, 22,015. So with that capital we raise, and we are calling the capital at the end because these figures are at the end. So we raise capital at start of the year. So for the first year, remember, the question was asking we get the taxable income from 2020. So capital for this one, we just required, the end of 2019 mark the beginning of 2020 so that we can come and bring it here, 16,268. Now, the end of 2020 mark the beginning of 2021. So it will be 16,248. This one comes here, 21,256. So this will give us now the growth in capital. net accounting profit. Which will be now this minus this, 16,248. And then we minus 16,268, which gives us negative 20, a loss. The other one will be 21,256. 21,256. And then we minus 16,248. It will give us 5,008. The other one is 22,015. And then we minus 21,256. It will give us 759. And then now, this being the net accounting profit, we adjust it by adding non-allowable expenses. Non-allowable expenses. So we go through the question to look for non-allowable expense, starting with whatever has been provided in the list of the item. Leasehold property, motor vehicle. In the middle, there is loss on sale of investment. We don't allow loss on selling of the investment, so we add it back. Loss on investment, which happened in 2020, so it will come here. So dash from here, 100 here, dash, dash. Then we go to the additional information because there is no other fixers, there is no other expense up there. Then additional information, number one, the drawings of goods and provision for taxation for the year 2019 was 600, 360 respectively, and had been accumulating at the rate of 10%. So in this case, we are told for the year 2019, it was 600. That is drawings. And the tax was 360 and had been accumulating. So those are not allowable. Tax drawings are not allowable. So we have the drawings where they should be growing by 10%. So we have 10%. So it means that now, since that was for 2019, for 2020 we'll have 110% of, we take the drawings for the first one, 600. For the other one, if it is for the tax, not for the tax, so we have tax provision, which we have a 110% of 360. So we'll have 110 of 600, which give us 660. So here we should be having 60. Remember 2019, we don't need anything. So 660. The other one would be 110 of 360, 396. And then this one will again multiply by 110 because they are growing by that, times 660. It will give us 726. We multiply again by 110, which gives us 798.6. We come back here, 396 times 110, which gives us 435.6. And then the other one, the same, times 110, which gives us 479. We round off 1602 to one decimal place. Then we continue. Capital allowance, that is not, it's allowable, not non-allowable. Donation to a political party in year 2020 amounted to that. That's not allowable. So donation, political party. Political party, of which case we have a 142 in 2020. The other one is gifts from relative. That's not an expense. Actually, it's an income. So we'll consider it maybe non-taxable income. Contingent liability that we had already accounted for under the liability here. The other one is rent paid on behalf of close relatives in 2022. That is not allowable. Rent for relative. Rent for relative, which you have 605. 605. So I like us to continue here. So I'll have 2019, 2020, 2021, 2022. A continuation. Then living expenses were estimated to be 800 in the year 2019 and has been increasing at the rate of 15% cumulatively each year. So we'll have living expenses. So we do the same. For the year 2019 was 800, and then you multiply by 115% to know how much would be for 2020. So that will be 800. Then you multiply by 115, giving us 920 times 115, which gives us 1058 times 115, which gives us 1216.7. So we are done with the non-allowable expense. Now we go to the non-taxable income and capital allowance. So we less capital allowance and non-taxable income. So we need the capital allowance and non-taxable incomes. So we are given the capital allowance already in point number 2. Capital allowance were agreed at a total of 920 for each of the 4 years. So we'll have capital allowance. Which we have 920, 920, 920. The only thing that remains is to look for non-taxable incomes. So non-taxable incomes, in the list up there, there is none. Additional information, number 1, there is none. Number 2, none. 3, none. 4, gift. Gift are usually not taxable income, so we need to remove them. Gifts. The gift which came in 2021, 840. Then liability, no. Number 6, rent paid on behalf of close friends, no. Living expense, nothing. So from there we can now get here net taxable incomes. So net taxable incomes, which will start from the loss, so negative 20, and then we add 100, then we add 660, and then we add 396, and then we add 142, and then we add 920, and then now we minus 920, which give us 1278. The next one, 5008, we add 726, we add 435.6, we add 1050, and then we minus 920, we minus 840, which gives us 54, 59.6. The last one, 759 plus 798.6 plus 479.2 plus 6 of 5, and then plus 12, 16.7. And then we minus 920. We have 2938.5. So this, remember, it is a point. Yeah. So that is the taxable income, and we have already answered the required number 1, where we were supposed to compute the taxable income or loss of Johnson Shauri for the year ending that 1st December 2020 and 2020, 2021, and 2022. So then you are supposed to summarize 3 specific actions that the tax practitioner could undertake upon discovery of irregularity in the client business. So here, so you can do this. This was for Roman 1. Now we have Roman 2. One of the things that you can do is not to notify the client. Notify the client of the irregularity. That is one. Another one is put measures to prevent further irregularity. And the last one, that when you discover there is irregularity in the client business, is to put measures. You can also put measures to prevent recurrence of the irregularity. So that is what you are supposed to do. Discover that there is irregularity in the client operations. So that is how you answer such a question. I'd like us to look at another question, same or about capital statement and back duty investigation.
Hello learner, welcome to Manifested e-learning platform. My name is F.A.M. Ningwiri and I am a practitioner within the financial services industry in Kenya. Ladies and gentlemen, today we are going to discuss about portfolio management. The focus is on contemporary issues and emerging trends. We are going to discuss about program trading, and we say the following, I can write the following, that it refers to volume trading, which is done by systems, executed by systems, usually automated, based on an underlying, based on an underlying, let me write it properly, apologies for that, underlying based on an underlying program or idea. Let's stop there for 1 second, guys. It refers to volume trading, which is done or executed by systems, usually automated, based on underlying program or idea. It is a wide range of portfolio strategies. It is a wide range of portfolio strategies, portfolio strategies involving the purchase or sale, involving the purchase or sale, purchase or sale of of stocks. We can say purchase or sale of 15 or more stocks, 15 or more stocks having a total market value, total market value of $1 million, $1 million, $1 million, or even more, Stop there. It is a wide range of portfolio strategies involving the purchase or sale of 15, ladies and gentlemen, or more stocks having a total market value of $1 million or even more. Now, once we have introduced what program trading is, it can almost be referred to as algorithmic trading, high volume trading that involves the utilization of a given number of strategies, ladies and gentlemen. And we're also saying that the strategies could be, or the types could be either principal, they could be either basis or even contra-day strategies thereon. So we can continue and say that program traders are almost always, traders are almost always program traders are almost always executed by computers. Executed by computers. Although there are instances in program trading, there are instances when this isn't the case, when this is not the case. For example, institution X, institution X wants to sell a basket of 15 stocks, a basket of 15 stocks totaling $2 million. $2 million. It would simply split up. It would simply split up the sale among different brokers, In other words, you're saying that people plan the strategy and you're saying the computers are the ones that do the work. So traders are almost, I've written R twice, are almost always trades are almost always executed by computers. But although there are instances when this is not the case. For example, institution X wants to sell a basket of 15 stocks totaling $2 million. It would simply split up the sale among different brokers. So when people plan strategies and the computer does the work, this is how program trading looks like. So we have this computer right over here. Please forgive my drawing right over here. And I'm saying that here is where the coding or the codes are actually created. Of course, there has to be what you're calling the CPU right over there like that, and it's the one that actually does or processes or executes trades. Buy and sell. I can put it in a different color over here. Buy and sell. Buy and sell of securities. Of securities. Buy and sell of securities. Then we are saying the types can be of 3 of them. Types of program trading can be where the principal over here we are saying this is where replication of an index is actually ensued. So replication of an index where the portfolio manager or the strategies try to copy the returns that have been generated by an index, and that is all done by the program trading or by the computer. So replication of an index. Then the second type of program trading is basis over here, and over here trying to identify price inefficiencies, strategy to identify price inefficiencies. So the computer tries to identify price inefficiencies, trying to identify undervalued stocks or tries to identify undervalued stocks. Undervalued stocks is what the computer system actually buys those stocks, of course using an algorithm, and then the overvalued stocks are actually sold. Then finally, the third type of program trading is contra trading, buying and selling through buying and selling consistently like that. So we're saying we buy in one market and sell in another market right there. So we're saying that's what happens in a contra. Buying and simultaneously selling the same security. Buying and selling the security simultaneously. So of course this uses futures or options, and that is actually executed using the computer system. So we are saying what? We are saying that the types of program trading include the principal, which involves replication of an index, and that is done by the system, by the computer system or algorithm. Basis trading, which involves a strategy to try and identify pricing inefficiencies, undervalued stocks and overvalued stocks. Then there is contra trading, where you buy and sell securities simultaneously in different markets using futures contracts. Let's move over on this other side. Let's look at the advantages. Advantages of program trading. We're saying it is quick to execute and implement. It is quick to execute and implement. Number 2, over here we say places trades according to strategy. it places trades according to strategy. Number 3, exploits opportunities without emotions. It exploits opportunities without emotions. So it is quick to execute and implement. Execute and implement are the keywords there. Second, it places trades according to strategy, either basis, principle, or contra. Actually executed using algorithms. So you can be able to come up with an algorithm that actually executes principal strategies, basis strategies, and even contra strategies. Very simple. It exploits opportunities without emotions. That is very key. So having looked at the advantages, we move over and discuss the disadvantages. Disadvantages. We are saying that number 1, it brings about extreme volatility. For example, in the 1990s, it brings about extreme volatility. And for example, in 1990s, there was a bit of a flurry of activity that took place as a result of program trading. Number 2, it is expensive. It is costly to implement and trade. It is costly to implement. So these are the 2 main disadvantages over here, that it brings about extreme volatility, for example, in the 1990s, and it is costly to implement. So this brings us to the end of the lesson. We hope you have enjoyed it, and I will leave you the assignment. The assignment is as follows, right down here. Assignment. Explain what is meant by program trading. Explain what is meant by program trading. So thank you for being with Manifested Publishers. Continue being with us, and we are here for you.
Hi students, welcome to another session of Manifested Online Classes. So in this session, I want us to continue with the topic on farm accounting, or accounting for agriculture activities. And specifically, I want us to do an illustration question regarding preparation of financial statements. But before you do that, there is a question which I want to give as an assignment. That is a question for April 2023, question number 5A. You check on that particular question. It was requiring you give some provisions of IS 41 as far as the measurement of agricultural produce are concerned, and also the disclosure requirement, the information to be disclosed if the fair value of agricultural produce cannot be ascertained reliably. So make sure you attempt that particular question. Equally, if you'll have a challenge in terms of answering that particular question there, I usually encourage my students to acquire this particular revision kit or this revision partner for Manifested Publishers. You'll be able to get now the solution for the same at the end of that particular book. So therefore, make sure you look on that particular question there. Now, for the purpose of illustration regarding preparation of financial statements, I want us to look on a question which is here, and I can go through it. And the question reads: the trial balance was extracted from the books of David Wekesa, a farmer, as at 31st of October 2019. So we are given the inventory that is on 1st November 2018. This is now the opening inventory for dairy cattle, maize which is growing, daily cattle feeds, fertilizer for maize, landed buildings, tractors, other cattle which are bulls, and then we have cats, which is the net book value purchases for daily cattle, fertilizer for maize, fertilizer for napier grass, and then we have maize seeds, daily cattle feeds. We have sales for milk, dry maize, green maize, daily cattle, manure, and then we have crop expenses, which include labor and other expenses, napier grass, labor. We have the general expenses. Then we have trade payables. We have capital as all on 1st November 2018, cash at bank, and then we have daily cattle expenses, which include manure, not manure rather, we have medicine, we have labor, other expenses. Then we have some additional information. Number one, you're given the inventory as at 31st of October 2019, which included dry, that is daily cattle, maize, which is growing, other cattle which are bulls, daily cattle feeds, and then we have fertilizer for planting maize. We have some additional information. Number two, we are told during the financial year which ended 31st of October 2019, the following distribution of farm produce were made. So we have the farm produce which were consumed by the family members, and then we have the milk delivered to relative hotel. You have to remember how we treat such farm produce. One farm produce which are consumed by the family members, we said this is accounted for as sales and also accounted for as what? As drawings. And then we have the milk which is delivered to relative hotel. This is like farm produce which are delivered or given to close relative. One, we account for that as sales, and two, we account for that as an expense in the general income statement. Number three, we are told manure valued at 600,000 removed from the cowshed and used in the maize plantation. This is what we refer to as the interdependence of department. Output from one department is an input in another department. So in this case, we said the producing department should account for that as sales, whereas the using department should account for that as purchases. Then we have the maize stock valued at 1.5 million used as daily cattle feed. The same case, in the interdependence of department. The producing department account for that as sales, the using department account for that as purchases. Then we are told the cattle bulls are used for pulling carts. So basically carts majorly are used in the farm, and what that means that these particular bulls then are used in the farm. Any information relating to the bull basically will be recorded in maize, or not in the maize lather, in the crop revenue account. And then number 6, you are told depreciation is to be provided on tractors and carts on the reducing balance method at the rate of 25% and 12% per annum respectively. Number 7, you're told income tax is estimated at 3.6. So what you're required to do here, Roman 1, is we prepare revenue accounts. You can see not one account, but two accounts. But from the information, or actually from the information which you're given there, it is important for you to note that David Wekesa was involved like in two farming activities. You can see we are given some information regarding daily cattle, meaning that David Wekesa was involved in dairy farming, and at the same time we are given information about maize which is growing, fertilizer for maize, and so on. So therefore we can say that David Wekesa was involved in some form of livestock keeping, which are dairy cows, and as a result of that we have said that you need to prepare a revenue account called livestock revenue account. Also, David Wekesa is involved in growing of maize. In such a case, you prepare something called the crop revenue account. So therefore, here we're going to prepare two accounts, the crop revenue account and the livestock revenue account. Roman 2, the income statement. This, what in other terms we have referred to as general income statement. And number 3, statement of financial position. So we start with the Roman 1 of that particular question, whereby we are required to prepare the revenue account for David Wekesa. So this is the revenue account. And we have said that the revenue account, this one is prepared using a T format. We prepare this using a T format. This will be the debit side. The debit side, whereas this is the credit side. The credit side, and this particular account will be having two sides. This is the credit, this is the debit. And then we prepare those two revenue accounts concurrently. We have now the crop livestock account. That is the crop revenue account and livestock revenue account. In the same case on the debit side, livestock revenue account and the crop revenue account. The livestock